And you think about this Goldman call, the idea really speaks to the complacency that's been in the market, spreads still being seen as very tight, even though you see parts of the economy weakening. You did see, even in a good economy last year, really default rates starts to rise to the highest levels you've really seen in more than a decade, barring COVID. So today, what type of stress do you see under the surface?
The stress, I think, Sonali, you said it well. 2024, you wouldn't expect to see so much stress, and we saw it. So now you get, and this was in an economy which was growing, equity markets which were strong. Now, with a little bit of a growth scare, with equity markets selling off as they are, if anything, it's gotten bigger. So I think, and by the way, the headline markets are, we all focus on the liquid markets. The headline markets, the credit spreads have widened out, like we saw in that chart just a moment ago. But underneath, in the illiquid markets, the bad stuff, right? It's illiquid. There are few buyers most of the any time anyway. Those few buyers disappear quickly. So underneath the surface, what you see going on, the sell-off is bigger.
How have you been playing the sell-off in the last couple of days, couple of weeks? Are you seeing the babies being thrown out with the bathwater and seeing specific credits that you could be buying? And do you dip in a way that is large?
Yeah, it's too early to. This is. We're just starting to accelerate. The sell-off is just starting, right? So the baby with the bathwater comment, too early. And I think our best sense, Sonali, would be we don't really think there is some recession in the U.S. It takes a lot to get the U.S. into a recession. So I think our point of view would be, hey, there's a lot more stuff coming. The pipeline is getting so much bigger than our already large pipeline, but it's not like a baby in a bathwater moment, which we set up in the next year.
Well, with that said, you did tell me that there is an enormous amount of activity out there in terms of the pipeline building. You mentioned to me that there's a universe of 200 companies that you're looking at.
Yes.
200 sounds like a lot. How many can you actually be buying into, and what are these companies' profiles looking like right now?
We have an investment team of about 100 people between the U.S. and Europe, right? So we've got one of the largest investment teams focusing on opportunistic credit, right? So the 200 companies, that's a curated list for us. And what we found is these are interesting businesses, leverage businesses, average enterprise value $1 billion to $2 billion, right? These are not big mammoth public enterprises. And in that list of 200, 18 today, the pricing to buy the debt coming into focus, right? 18 is a lot.
Yeah.
18 is a lot, but and by the way, if I had told you they had the same conversation in October, November last year, it would have been 10 or 12. So it's really kind of picked up.
It's interesting because what's happening is you have a private equity universe that has been saddled with so many companies. The IPO market has not come back. The M&A market has not come back as many investors have hoped. Investors want their money back, yet instead you've seen so many what they call amend and extend. Can they keep doing that? Or ultimately, are you going to find that you're going to be taking control of more businesses?
The amend and extend game, it's stuttering, right? What happened with, there were lots of A&Es, amend and extends done in 2021, 2022. And what happens is, an amend and extend, as you can appreciate, is you kick it out for 3 years, and you hope that the company can grow into that capital structure. Interest rates have gone up a lot since 2020. It's hard to grow into that levered capital structure, and you probably took on even more debt to do an amend and extend. So I think, you said it rightly, default rates are 4.9% in 2024. Those are very high default rates in high yield. And the default rates are high because these amend and extends taken together with bankruptcies, they are just starting to kind of mount up where we are.
It's fascinating because in many of the restructurings that we've seen come to the surface, you've looked at the private equity industry really try to have a lot of leverage here, and they're trying to keep their equity intact.
Yeah.
Do you think that there's going to be more lender pushback? Are there going to be a lot of broken hearts on Wall Street with the way that the infighting is kind of playing out between the lender community and private equity?
It's a game where it's an arms race, right? The creditors do one thing, the private equity guys do another thing, and the arms race just continues. So it used to be, so more recently, the lenders have started to push back. There's something called a co-op group. So the lenders will say, you can't pick us off one by one. We are all going to work together. 80%, 90% of us, right? We're all going to kind of work together to negotiate an appropriate deal with you. And then I'm sure private equity will come back with the next kind of round of a little extra. But I think the arms race around this on both sides, right? The tooling just keeps on getting bigger. The lawyers do quite well with this.
One question I have, as somebody, I believe you had 6 control deals in 12 months.
Yeah.
Do you see this issue coming up in private equity more and more, where things are turning quickly? You have the public markets that have been fluctuating drastically. Those private equity marks have not really kept up. In part, that's the reason private equity exists. But to what extent do you see marks that are meaningfully lower or should be meaningfully lower than what is currently hitting the paper?
Yeah, no, look, I can only assume that the marks are lower. I mean, so there's a lot of popular press on it, because if the marks were, quote, prices at which you can sell at market, people would be selling. So I think the very reasonable assumption is marks are lower. But can I go back to something you said earlier? Yeah, we took control of 6 businesses last year in 2024. Average enterprise value, about $1 billion, give or take, right? Some of these deals were deals which had gone through an amend and extend, and which kind of ran into problems kind of afterwards. Some of them were deals which were just in trouble, period. Some of these deals we bought equity, but the entire capital structure was very levered. We paid a sliver for the equity in some of these cases, right? So the opportunity set, when you think about what happened last year, please.
To your point that you keep on making about last year, the opportunity set being huge, we can't let you go without talking about tariffs and what that means for the opportunity set this year of companies that are getting into trouble. So
that huge opportunity set for us just got larger. So with tariffs, and the expectation was the tariff wars have gone deeper. But Sonali, tariffs is just the tip of the iceberg, right? Over the last couple of months, we are redrawing geopolitical lines. At the same time, we have tariffs. We are trying to reinvent the federal government. There is a lot, both externally, geopolitically, as well as economically. We are in the middle of a transition looking to change everything. And as a result of that, the uncertainty is maddening. The uncertainty is climbing, which is why when you kind of look at it today, you see underneath the surface, the angst levels have just gone up tremendously. Our deal pipeline has started to grow by leaps and bounds.
So before I let you go, I do want to get your view here on the real estate market, because you have seen massive investors starting to get into even the hairiest parts of it, even commercial real estate offices. Do you think that there's a lot more pain still ahead, even in places that were previously considered a little safer, like multifamily?
Office has been the center, it's been the place of real attention in real estate. And because, office is in the middle of a secular decline. 20% vacancies in New York, right? And so office has been clearly a focus. But what I was describing earlier with maturities coming due, same thing exists in all kinds of real estate. You have much higher interest rates. You have to refinance your debt. There is no such thing as an A&E in commercial mortgage land, right? So what we've found is the multifamily side, the retail side, the problems which exist in office, it's much bigger. For somebody like us, real estate is about typically 15, 20% of what we do as a firm. But for somebody like us, we have bought or are in the process of closing on 4 properties, $1.5 billion gross asset value, about 500 million or so of equity. And I don't think we would have thought 2 years ago Class A properties like this were there.